With their remarkable 51 consecutive years of constant dividend hikes, PepsiCo could quench the thirst of many dividend investors over the last decade. During the last months, though, Pepsi had a rough time and the stock fell about 15%. So in this video, we'll analyze if the recent dip in Pepsi is a good long-term buying opportunity or if their business is at risk from new trends like the emergence of appetite-suppressing drugs like Ozempic. We'll dig into the business model and the markets of Pepsi, analyze the moat by doing a Porter's 5 forces analysis, and we'll have a look at the latest financial statements to see how they're doing financially. We'll also compare the valuation of Pepsi to their peers and see if they are fairly valued by doing a discounted cash flow calculation. And in the end, we'll see if Pepsi is a good long-term investment for us or not. Pepsi has the ticker symbol of PEP on the New York Stock Exchange. They work in the consumer staples sector, were founded in 1898 and have around 350,000 employees. The headquarters sits in Purchase, New York, and their market cap at around $235 billion US. Let's start by comparing the performance of the Pepsi versus S&P 500. I'm looking at the total return here because Pepsi is a dividend payer. And first we look at the 5-year performance of Pepsi orange line versus S&P 500 in the blue line. And we can immediately see that Pepsi did underperform the S&P 500. But most of this underperformance just comes from the last couple of months, from last half year or so, from this recent dip of Pepsi. When we look at the 10-year period, Pepsi did also underperform the S&P 500 by about 30%. But you can also see that they were very well on track until the middle of this year, beginning or middle of this year. And only in the last couple of months, Pepsi started falling behind. When looking at the trend over the last years, we can see that Pepsi was sometimes a little bit over the S&P 500, sometimes a little bit under the S&P 500. But in general, it's a very nice uptrend here. And we can even see that the beta, the fluctuation of Pepsi, is much, much lower compared to the S&P 500. When we compare the performance of Pepsi against their peers, and I used Coca-Cola, Nestle and Mondelez here, we can see that Pepsi, the orange line, did perform best from all of these. And the outperformance is not only recently, but it looks like they did outperform over the whole time frame of this 10 years. In the last couple of months, we can see that all of these companies had a slight dip. So it seems like this is not only related to Pepsi, but to the whole market. In case you're wondering what Pepsi is actually doing, they are manufacturer and supplier of all different kinds of beverages and convenience food and snacks. So you can see a whole plethora of different brands that all belongs to PepsiCo. For example, we can see the Gatorade brand, the Mountain Dew brand, of course, the Pepsi Cola brand, Rockstar. We can see Lay's chips down here, also Cheetos and Doritos, and also the Quaker brand belongs to PepsiCo. They also sell third-party brands like Starbucks coffee for convenience stores. So when we look at the split of the different segments, first of all, we can see down here, the revenue between food and beverages is split around 40-60. Almost 60% are coming from the food sector and remaining 42% are coming from the beverage sector. The net revenue is distributed like this. So here we can see that Frito-Lay already makes up for 27% of the net revenue, and Pepsi Cola beverages North America make up 30% of the net revenue. The remaining brands make up of the rest of the revenue. When we look at the operating profit, it looks a little bit different. Here we can see that Frito-Lay makes up 44% of their operating profit. PepsiCo Beverages is the second biggest with 90% here. In this case, we can see that a lot of their profit is generated by only one brand, even though they have this huge plethora of different brands. There is definitely a risk involved in such a high concentration with only one brand. When we look at the mix over the different countries, we can see that almost 70% of the revenue is generated in the US and only 43% is generated outside of the US. So not only have we a huge concentration on one brand, but we also have a concentration on only one country here. When we look at the markets, first, the snack food market, we can see that the snack food market until 2030 is expected to grow with a CAGR of 3.75%. Nothing to write home about, but still nice growth, so there are still secular trends and the overall market is still growing. Same is true for the soft drink market. Here we can see that the CAGR until 32 is actually expected to be 4.2%, so a little bit higher compared to the snack food market. When we look at the numbers provided by Pepsi itself, we can see that they expect to grow with a CAGR of 5% over the next 5 years in the convenient foods industry, and the same with a CAGR of 5% in the beverages industry. So Pepsi thinks that they can grow quicker than the overall market. How are they planning to do this? First of all, in the last years and in the future, they are planning to move further from supermarkets to more e-commerce. And also they are planning to do this away from home, where you can get your chips delivered, for example, your food delivered. Or also they are establishing these vending machines where you can purchase the food, but also the drinks on site. Also, they are planning to optimize their business and their efficiency. First of all, by implementing more robotic solutions in their plans, to bring the different brands online with one system and harmonize the technology systems between the different brands. So to use their network and size effects. Also, they plan to invest in more automation. They even state that they could already save at least $1 billion since 2019 with these kind of optimizations. One trend that recently made headlines across the globe is the development of these weight loss or appetizing reducing drugs like Ozempic or Wegovy. When we look at a couple of headlines here, we can see that at the moment PepsiCo still expect that these weight loss drugs are not having an impact on their stocks yet, but there is still there are growing concerns in the industry and also in the food industry. So we can here see, for example, that right now the CEO of Pepsi, Raymond Lagarde, already told analysts that the impact on this business as of today is neglectable, but still they should keep a very close eye on this and also on the trend, how it develops in the next years. Here, for example, we can also see that PepsiCo boosts the forecasts even though the Ozempic trend and threat increased in the last couple of months. This is a new trend. So, of course, a lot of investors are worried at the moment, but still I think it's too early to say if there is really an impact or not. And actually, they are also saying that it's very early days of these popular drugs. So it still needs to be seen if these drugs can even be used on a long-term basis, because there are not so many tests right now for the usage as weight loss drugs. Initially, these drugs were implemented or developed as diabetes drugs. So for the time being and for the next couple of years, I think the development of these drugs won't have such a big impact on companies like Pepsi. When we look at the mode of Pepsi by doing the Porter's Five Forces analysis, I think the threat of new entrants, first of all, is medium. It is definitely not unheard of that new brands enter the consumer food sector and the beverage sector. It honestly happens quite regularly, but Pepsi is the biggest player in this field, so they definitely have some advantages of scale, especially when it comes to new product development, marketing or branding. Also, as we just heard already, they are working on optimizing and unifying the technology for manufacturing and so on, and also the IT systems from all of their brands. So they have some scale effects here they can take advantage of. When we look at the threat for substitutes, I think it's also quite high. Again, we are in the consumer sector here, so it always depends on the consumer and the end customer. The switching costs here are neglectable. So if there is a new trend for a new beverage or a new chip, something gets hyped or so, then the consumer will happily switch to this new product. And customers are getting more health aware and are looking for alternatives that are healthier with lower sugar content, lower calorie count. The competitive rivalry is also quite high in the sector. With their branding and marketing, they have a huge name. They are very well known in the market. This brings them an advantage, but it doesn't change anything that the competitive rivalry is very high in this price-driven market. The bargaining power of their customers is also quite high. Again, this is related because Pepsi is selling to the end customer, so it's highly price sensitive. Substitutes are available very easily and the switching costs are basically not there. The bargaining power of their suppliers, on the other hand, I would think is medium to low. The suppliers of raw material like packing or flavoring or so, they are quite interchangeable. But there are a couple of key suppliers that are really very important for Pepsi, and they cannot be substituted very easily. So when we look at the overall picture, it looks to me that the overall mode of Pepsi is not that strong, and they are very dependent on recent trends, on new product developments, and also on the consumer behavior. Let's jump into the financials of Pepsi now. First, by looking at the income statement of the last years and the forecast for the next years. Here we can immediately see that the net income from 2018 dropped significantly to 2019. But this can be explained due to some unusually high net income of Pepsi in 2018. That was due to some merger and divestments they had in this year. From 2019, the net income trend and also the operating profit trend is pointing upwards, and you can also see the forecast for the next years is also showing upwards. Same is true when we look at the margins, net margin and operating margin. They have increased in the last years and they are still increasing in the next years, although the speed of the increase is expected to slow down a little bit. The balance sheet also looks quite nice. Here we can see that the leverage jumped up from 2019 to 2020. The main reason for this is that PepsiCo acquired Pioneer Foods and B & Cherry in 2021, and they did finance this by issuing some debt. But we can also see that since then they could deleverage the balance sheet again. The debt is coming down slowly but surely while the EBITDA still is going up. This is a nice trend to see, and the current leverage of a bit higher than 2%. If you look at the latest quarterly report, it sits at almost 2%. That is well within my region of comfort. The revenue trend of PepsiCo also looks to be quite nice. It was flat in the first half of the century, but since 2018 we can see that the revenue increase is picking up speed again, and especially in the last couple of years we had quite a nice increase here. For the free cash flow, it looks a little bit different, unfortunately. Here we can see that the free cash flow, the blue line in this graph, is very flat over the last decade. So we didn't have much growth here. Only from end of 2022, it seems like it picked up a little bit speed again. When we dig a bit deeper into the revenue and we have a look at the yearly report for 2022, first of all, we can see that we had a growth over almost all of their segment except the European segment. And the European decline is because of the Ukraine war, and they had to remove the business from Russia. All the other regions were actually positive. But when we look where this is coming from, the organic volume growth is only very small and even negative in some cases. For example, Quaker, North America, but also Europe, as we just saw. The majority of the increase actually comes from price increase. And when we look at the last quarterly report from October 2023, we can even see that the organic volume declined in all of these segments. And the only positive aspect here was the price increase. So the increase of the revenue in the last 2 years mostly came off pricing increase, not organic volume growth. This trend is somewhat worrying to me because it cannot continue indefinitely. Pepsi cannot continue to increase the prices on a year-over-year basis while the volumes decline. Last but not least, let's check the dividends of PepsiCo, because dividend is quite a stable dividend grower and dividend king, as we mentioned in the beginning. They are sitting at a comfortable 3% dividend yield right now. Payout ratio is 64%, which is a little bit high, but still in the okay range. and the 5-year growth rate was at 6.6% here. When we look at the dividend grade at Seeking Alpha, the dividend yield of Pepsi is a little bit higher compared to the sector median, so they are currently paying a higher dividend compared to their competitors. So as a dividend investor especially, this looks quite interesting. Also, when we look at the 5-year average dividend yield, trailing 12 months, but also forward yield, we can see that both of these are currently higher than their 5-year average. So it seems like it's a good time to buy Pepsi for their dividends. When we sum this up by looking at my checklist, we can see that first of all, the revenue growth in the last 5 years was higher than 7%, and the year-over-year value is almost 10%, definitely a green checkbox for me. Although we also saw that this is mainly coming, especially in the last years, due to price increases, not organic growth. I'm not sure how long Pepsi can continue with these price increases. If they cannot achieve any organic growth in the next years, I think this would be a very worrying trend. When we look at the net income growth, the year-over-year value, they declined by almost 15%. It's not nice to see. But over the last 5 years, there still was an increase of more than 10%. So it's still a green checkbox for me, although we need to, again, observe the trend, how this will continue in the future. For the free cash flow growth, it's actually the same. The year-over-year value declined by more than 11%. In this case, please keep in mind that the latest numbers are coming from the 2022 yearly report. From then on, we already had 2 quarters, new reports from Pepsi, where they could increase the free cash flow again a little bit. So by end of 2023, the year-over-year value looks a little bit better, but the CAGR of the last 5 years still will be on a very low growth basis. So this is definitely a red checkbox for me. For the free cash flow yield, it sits at 2.3%. It's a little bit below my threshold, but it's still not too bad. So it's a yellow checkbox for me here. And when looking at the balance sheet, we already saw that PepsiCo has a very clean balance sheet. The debt to EBITDA sits at around 2 times. That is clean balance sheet, nice to see, not too leveraged, so they get a green checkbox for me. Pepsi is a steady dividend grower, they are dividend king. They grew their dividend over the last 51 years. Right now they sit at a dividend yield of a little bit higher than 3%, and they grew their dividend over the last 5 years with a CAGR of 6.6%. So also quite a nice value, especially when considering that PepsiCo already is such an established and mature company. The margins and the return of invested capital, like we also saw in the income statement, is quite stable over the last months, over the last years. It is even increasing a little bit and expected to increase in the next years. And we saw from the presentation from Pepsi itself that they are planning to increase their operating efficiencies, to use synergy effects between the different brands. So they are definitely trying to bring up these margins even higher than they have today. When we compare the valuation of Pepsi to their competitors like Coca-Cola, Monster Energy Drink, Nestle and Mondelez, we can see Pepsi is the orange line here. They are in the middle of the pack, so to say. Right now they are on par with Nestle and they are right in the middle between all their competitors. So it seems to me that they are not overvalued, but also not much undervalued. Looking at the price to cash flow and the PE value of Pepsi itself, we can see that the price to cash flow ratio did increase over the last 10 years, but just recently it came back down again and sits at a more medium value, especially when comparing over the last 5 years. In the 5 years before that, it was a little bit lower. The PE ratio had some jumps up and some jumps down, but right now, again, we are sitting around the middle point, at least of the last 5 years, if not the last 10 years. So at the moment, when looking at the multiples, Pepsi doesn't seem to be overvalued, but they also don't seem to be overly cheap. In addition to the multiples, for these kind of dividend payers, dividend aristocrats, I always like to look at the average dividend yield to also get a better grasp of the current valuation. And here we can see that right now Pepsi is sitting close to 3%. In the latest numbers we saw even 3.01% dividend yield. Compared to the last 5 years, this is a very good dividend yield. There haven't been so many times where Pepsi have been above 3% dividend yield. In the last couple of years, it was mostly around 2.5% or so. So when looking from a perspective of a dividend investor, it seems like now is a good time if you want to lock in these 3% dividend yield that Pepsi has right now. Let's calculate the fair value by using my discounted cash flow model now. First of all, I have to make one remark about my WACC calculation. My WACC calculation seems to be a bit skewed. I get 3.7% WACC. This seems to be quite low, so I did double check this with a couple of different fair value calculations that are available online, and it really seems like my calculation is a bit off here. So instead of the 3.7%, I used a discount rate of 7.5%, which seems to be the general average that I could find. And by plugging in the numbers of the last 5 years here, you can see the free cash flow growth rate of 1% that we had as a CAGR of the last 5 years. We have the average price to free cash flow multiple of the last 5 years. Same is true for the PE value and the net income growth rate. And for the Gordon growth model, I assumed the dividend yield that is expected for next year and a long-term growth rate of 4.5%. Currently, Pepsi is even sitting at a bit higher percentage, but I think if you look at the very long run, 4.5% is quite a good value to assume for dividend growth rate. So when plugging in these numbers, we can immediately see that the fair value from the discounted cash flow analysis is very, very low, especially when we compare it to the current stock price of almost 170. It's much lower than this. The biggest reason for this is, of course, the very low free cash flow growth rate. When we look at the multiples calculation in the Gordon growth model, though, we can see that the fair value seems to be almost on par with the current stock price. In this case, even when including my margin of safety of 10%, we are very close to the current value of 168. In case of the multiples calculation, even a little bit lower. So to sum this up, on one hand, we have the risk of Pepsi, for example, the huge focus on the North America region, which makes up almost 60% of their shares, and also the reliance on key brands like Frito-Lay, which makes up 44% of the operating profit. So huge reliance on this one brand only. Also, we have these new trends to the appetite reduction drugs like Ozempic or so, and the long-term trend to healthier foods, which Pepsi tries to follow to a certain degree. It's just a little bit unsure how they can compete against other players that are only focusing on healthy food here. Also, we saw that that Pepsi has a very small moat, and there is a huge competition in this field. So it will be definitely a struggle to keep up the pole position in this market for them. On the other hand, we have the growth prospects. For once, I want to mention here, the Pepsi is already focusing on healthier foods with lower sugar content and lower calories. So they are trying to follow this trend. As the biggest player in this market, they have the biggest opportunities for merger and acquisition, of course, and of strategic partnerships like we saw with Starbucks, for example. Also, the branding value of Pepsi is very large. They have a huge name, and the branding and marketing is one of the biggest strengths here. With a focus on e-commerce and the optimization and improving of efficiency in production and so, they could increase their operating margin, or they hope to increase the operating margin and cross margin. In the end, I think that Pepsi is still a good value, especially for long-term dividend investors. If they want to lock in the currently quite high dividend yield of Pepsi of 3%, although the trend of increasing revenue only by increasing the prices instead of organic growth is really worrying me at the moment. So in Pepsi's case, I really think it vastly depends on your investment strategy. If you're focusing on these dividend and dividend growers, it might be a good time to invest in Pepsi right now. On the other hand, if you're focusing more on the total return and the long-term growth of companies, the recent trends that Pepsi shows make an investment less appealing to me right now. That being said, I'm not a financial advisor. I do this for entertainment and education purpose only. Please do your own analysis to see if Pepsi fits into your portfolio and is a good investment for you or not. Please let me know down in the comment section what you think of Pepsi, if you want to add Pepsi to your portfolio right now or not, and if you think that Pepsi is a good investment or not. Also, I would be really interested to hear your opinion of Pepsi, if I missed something in my analysis, or if you agree or disagree with any of my points. Thank you very much for watching, guys. See you next week. Bye-bye.